Hello, I'm Edward Sterling, macro analyst for Bulwark Bullion. Gold has quietly returned to the center of the financial conversation. Prices have climbed toward historic highs. Central banks are accumulating the metal at the fastest pace in decades, and investors increasingly see gold as protection against rising economic and geopolitical uncertainty. But that raises a fundamental question. Should you actually invest in gold? Because gold is one of the most widely discussed assets in global markets, yet it's also one of the most misunderstood. Some investors treat it as the ultimate safe haven, others dismiss it entirely because it doesn't generate income, and both views miss something important. Gold is neither a miracle investment nor a useless relic. It serves a very specific role within the financial system, and understanding that role is critical if you're trying to decide whether gold belongs in your portfolio. Over the past few years, gold has been moving higher as several major macro forces began converging. Central banks have become one of the largest sources of demand. In both 2022 and 2023, central banks purchased more than 1,000 tons of gold, the largest accumulation in modern history. That kind of buying isn't normal. Countries including China, Turkey, and several emerging markets have been steadily increasing their gold reserves as they attempt to diversify away from traditional currency reserves. At the same time, global debt levels have surged. Government borrowing has expanded dramatically across the United States, Europe, and much of the developed world. Fiscal deficits remain large, and central banks are navigating a difficult balance between controlling inflation and maintaining economic growth. Markets appear to be recognizing that the long-term stability of the monetary system may face increasing pressure. And historically, those are the kinds of conditions where gold tends to attract attention. The single most important factor driving gold is real interest rates. Real interest rates represent the return investors earn after adjusting for inflation. When real yields rise, investors can earn attractive inflation-adjusted returns from assets like government bonds. But when real yields fall or become negative, the opportunity cost of holding gold disappears. And that's when gold tends to perform best. Think about the mechanism. If inflation rises while interest rates remain relatively low, the purchasing power of money begins to erode. Investors start searching for assets that can preserve value. Gold becomes one of those assets because its supply cannot be expanded easily. New gold production grows slowly, typically around 1 to 2% per year, which helps maintain its scarcity. In other words, gold tends to thrive during periods when investors begin questioning the reliability of fiat currencies. While real interest rates are the primary driver, several additional forces also influence gold markets. The first is the US dollar. Because gold is priced globally in dollars, movements in the dollar often have a direct impact on gold prices. A stronger dollar typically creates pressure on commodities, while a weaker dollar tends to support higher gold prices. Another important factor is geopolitical risk. During periods of major geopolitical tension or financial instability, investors often rotate toward assets perceived as safe havens. Gold has historically played that role. And then there is central bank demand, which has become an increasingly important structural factor in the gold market. When central banks accumulate gold, they are effectively signaling a desire to hold assets that exist outside the traditional financial system. That trend may represent a broader shift in how governments manage monetary risk. Before we go further, if you're enjoying this breakdown of the precious metals market, make sure to hit the like button and subscribe to the channel. Gold offers several important benefits for investors. The first is portfolio diversification. Stocks and bonds often move together during periods of financial stress. Gold, however, has historically exhibited a relatively low correlation with traditional financial assets. That means it can sometimes rise when other assets fall, helping reduce overall portfolio volatility. The second advantage is liquidity. Gold is one of the most liquid commodities in the world. Investors can access it through physical bullion, futures markets, exchange-traded funds, and mining equities. That flexibility allows gold to fit into a wide range of investment strategies. But perhaps the most important benefit is its role as monetary insurance. I've followed precious metals markets for years, and one pattern consistently appears. Gold performs best during periods when confidence in the financial system begins to weaken. That might involve inflation shocks, banking instability, sovereign debt concerns, or geopolitical crises. Gold tends to rise when investors begin asking uncomfortable questions about the long-term stability of currencies. However, gold also has significant limitations. The most obvious is that gold produces no income. Unlike stocks that pay dividends or bonds that generate interest payments, gold does not produce cash flow. That means investors rely entirely on price appreciation to generate returns. During periods when interest rates are rising and yields become attractive, gold often struggles to compete with income-producing assets. This dynamic has produced some long periods of underperformance. For example, after peaking near $850 in 1980, gold entered a prolonged bear market and eventually fell to around $250 by the late 1990s. That decline lasted nearly 2 decades. Another example occurred after the 2011 peak near $1,900, when gold spent several years correcting and consolidating before the next major cycle began. These periods remind investors that gold is highly sensitive to broader macro conditions. To understand gold markets, you need to follow the chain reaction that moves capital through financial markets. Consider this sequence. Rising inflation increases concerns about the purchasing power of currencies. Bond investors begin demanding higher yields to compensate for inflation risk. If central banks allow real yields to fall, meaning inflation rises faster than interest rates, gold becomes more attractive. Lower real yields reduce the opportunity cost of holding gold. At the same time, inflation fears may weaken the dollar and increase demand for hard assets. The result can be powerful rallies in gold prices. But the opposite can also occur. If central banks aggressively raise interest rates and real yields move higher, gold often faces downward pressure. That dynamic explains why gold can experience long periods of stagnation during strong economic expansions. Today's macro environment contains several factors that historically support gold. Government debt levels across advanced economies remain extremely high. Fiscal deficits continue expanding. Central banks face persistent inflation risks while attempting to maintain financial stability. These conditions create tension within the global monetary system, and that tension is one reason central banks themselves have been accumulating gold reserves. Markets appear to be slowly adjusting to a world where traditional monetary frameworks face increasing strain. Gold may benefit from that shift. If you're evaluating whether to invest in gold, several indicators deserve close attention. First is the 10-year real Treasury yield, which often provides one of the clearest signals for gold markets. Second is the US dollar index, since dollar strength or weakness directly influences global commodity prices. Third is central bank gold purchases, which have become an important source of structural demand. And finally, investors should watch inflation trends and Federal Reserve policy expectations, both of which shape real interest rates. Together, these factors help determine the broader direction of gold prices. Gold is best understood not as a growth investment, but as financial insurance. It is an asset that tends to perform well when traditional financial assets face stress. That's why many investors choose to hold a modest allocation to gold as part of a diversified portfolio. Gold may not outperform during every economic cycle, but during periods when confidence in the monetary system begins to weaken, its role becomes much more important. If global debt continues rising and central banks face increasing pressure to manage inflation and financial stability, could gold's role as monetary insurance become even more valuable in the years ahead? Thanks for watching. If you're interested in gold, silver, and the macro forces driving global markets, make sure to like the video and subscribe. For more analysis, visit bulwarkbullion.com. I'm Edward Sterling, macro analyst for Bulwark Bullion. See you in the next one.